This is Abhinaya, Assistant Professor of Commerce. This unit covers about international investment decision. International investment. International investments are those investments that are made outside the domestic markets and offer portfolio diversification and opportunities for risk minimization. An investor can make international investments, thereby broadening his portfolio and expanding his horizon of returns. International investments also serve as a means of adding different financial instruments to the list when domestic markets are confined and limited by their variety. Investors in one part of the world may find a variety of combinations of equity and debt instruments being traded in some other part of the world. International investments aim to assure investors of two probabilities: the counter of domestic market risks and the opportunities in foreign markets. Foreign direct investment. A foreign direct investment is an investment in the form of a controlling ownership in a business in one country by an entity based in another country. It is thus distinguished from a foreign portfolio investment by a notation of direct control. Foreign direct investment. The purchase of an interest in a company by an investor located in another company. International capital budgeting. Capital budgeting is a process of investigation and analysis that leads to a key financial decision for both purely domestic firms and MNCs. More broadly, capital budgeting is defined as the process of analyzing capital investment opportunities and deciding which, if any, to undertake. While calculating the cash flows for international capital budgeting, the following accounts must be taken into account while calculating the incremental cash flows. International portfolio investment. Meaning, an international portfolio is a selection of stocks and other assets that focus on foreign markets rather than domestic ones. If well designed, an international portfolio gives the investor exposure to emerging and developed markets and provide diversification. Benefits. Foreign portfolio investments boost demand for the stock of companies and help them when it comes to raising capital at low cost. The presence of FPI would mean a significant rise in the depth of the secondary market. From the investor's perspective, it helps an investor add more diversity to their investments and benefit from such a diversification. Investors can also gain benefits from exchange rate changes. Overseas markets provide investors a change to a bigger market that may also sometimes not be as competitive as their home market. This means they benefit from the lower competition in a foreign country. A huge advantage of FPI is that it is liquid, ensuring that the investor is empowered and can move fast when there are good opportunities. Risk in international investment. Investing internationally may pose unusual risks compared to domestic investing, such as market or liquidity risk, economic risk, currency risk, political risk, regulatory risk. The Index of Economic Freedom measures a country's economic environment, growth potential, and regulatory cost, which affect investment risk. Greater investment risk require more research to gauge their effects on an investment opportunity and the overall investing environment.